This week in the world of Meta platforms, the big story isn't just one headline, but a series of massive, multi-billion-dollar moves to secure its future in artificial intelligence. The company is spending on a scale that's turning heads and raising questions. While Meta is striking huge deals for AI chips left and right, its stock has been under pressure, losing about 11% in the month following its last earnings report. So, is Meta's aggressive spending a brilliant long-term play or a high-stakes gamble that's making investors nervous right now? Welcome to TickerWatch News for Meta, Week 9, 2026. This week is all about Meta's colossal investments in its AI infrastructure, the strategic partnerships shaping its future, and how the market is reacting to this spending spree. It was a challenging month for Meta's stock. In the time since its last earnings report, shares have fallen by about 11%, a period where the stock underperformed the broader S&P 500. This decline comes as investors are weighing the company's long-term vision against the staggering near-term costs. The central theme appears to be investor anxiety over the sheer scale of the company's planned capital expenditures on artificial intelligence. The biggest news revolves around Meta's aggressive multi-vendor strategy for AI chips. The company is no longer relying solely on its primary partner, NVIDIA. This week brought confirmation of two massive deals. First, an agreement with Advanced Micro Devices, or AMD, to deploy up to 6 gigawatts of AI compute power. This multi-year deal could be worth over $100 billion and structured with performance-based warrants that could give Meta up to a 10% equity stake in AMD. Just after that, reports confirmed Meta also signed a multi-billion-dollar deal with Google to lease its specialized tensor processing units, or TPUs, adding a third major supplier to its arsenal. This follows a previously announced partnership with NVIDIA for millions of its next-generation Blackwell and Rubin GPUs. This diversification strategy gives Meta more negotiating leverage and hedges against supply chain disruptions. However, it also highlights the monumental cost of its ambitions, with capital spending for 2026 projected to be between $115 and $135 billion. This pivot to external partners seems even more critical in light of reports that Meta has hit a snag with its own chip development. The company has reportedly scrapped its most advanced in-house AI training processor, known internally as Olympus. This setback underscores the immense difficulty of building cutting-edge chips that can compete with those from specialized firms, and reinforces Meta's current strategy of relying on a diversified set of outside partners. But why all this spending? Recent reports show it's driving user engagement. On Instagram, Reels watch time was up more than 30% year-over-year in the United States. On Facebook, video time continues to grow by double digits. These gains are attributed to an improved AI-powered recommendation system. This focus on AI is also helping advertisers, with the company currently testing a Meta AI business assistant to help optimize campaigns. In other developments, Meta appears to be cautiously dipping its toes back into the world of digital payments. Reports suggest the company is experimenting with using established stablecoins for payments across its apps. A company spokesperson clarified this isn't about creating a new Meta coin, a lesson learned from the failed Libra project, but about enabling users and businesses to pay with their preferred methods. This could open up new avenues for commerce, particularly for creator payouts and cross-border transactions. Finally, to power all this new hardware, Meta is looking to new energy sources. The company has signed long-term power purchase agreements with several nuclear energy providers, including Oklo, Vistra, and TerraPower, to help supply its energy-hungry data centers. One deal with Oklo alone is for a 1.2 gigawatt advanced nuclear campus. This aligns with a broader push from the White House for tech companies to source their own power for new data centers. The market's reaction to Meta's strategy is decidedly mixed. On one hand, there's acknowledgement of the company's powerful position in the AI race. Bank of America, for example, reiterated its buy rating and an $885 price target, citing the AI opportunity. On the other hand, the dominant narrative is one of investor anxiety over the massive and escalating capital expenditures. This skepticism is reflected in the stock's recent performance.
While analysts see the multi-supplier chip strategy as a smart long-term move to lower costs, the near-term price tag is pressuring the stock. The sentiment appears to be a tug-of-war between the promise of long-term AI-driven growth and the immediate financial burden of building it. From a fundamentals perspective, the narrative of growth versus risk is front and center. Meta's growth story is tied to its AI investments fueling user engagement and ad revenues. The risk is all about the price tag. With 2026 capital expenditures guided as high as $135 billion, there are concerns about the pressure this will put on margins and free cash flow, especially with a clear return on that investment still years away. Valuation metrics are also mixed. One analysis notes Meta's price-to-earnings ratio is around 27.5, compared to an industry average of about 15. Another firm, Simply Wall Street, views the shares as potentially undervalued. This split reflects the broader uncertainty. Investors are trying to determine whether the company is making a necessary visionary investment or simply overspending in a hyper-competitive AI arms race. Looking ahead, investors will be watching for any commentary from Meta's chief financial officer, Susan Li, who is scheduled to participate in the Morgan Stanley Technology, Media, and Telecom Conference on March 4th. Her remarks could provide more color on the company's spending strategy and AI roadmap. The broader bull and bear cases for Meta are now clearly defined. The bull case is that these massive AI infrastructure investments will pay off, leading to sustained growth in user engagement, ad revenues, and new monetization opportunities through AI-powered services. The multi-vendor chip strategy will successfully secure the necessary supply while keeping costs in check. The bear case is that capital spending continues to spiral without a proportional return on investment. Competition remains fierce, and setbacks with in-house projects could leave Meta heavily reliant on expensive external suppliers, pressuring margins for the foreseeable future. Thank you for tuning in to this week's update on Meta Platforms. Please remember, this podcast is for educational purposes only and is not financial advice. We encourage you to subscribe, leave a review, and share this episode. Join us again next week for more news from TickerWatch.